What is going on, guys? Good evening. It's your favorite mortgage lender, Abdel Kwame, got mortgages. Man, there's so much to talk about. We had a pretty crazy week last week when it came to inflation. Right, we got consumer price index, producer price index, and everything came actually below expectations, which was great from producer price index on the wholesale level to on the consumer level. But then there's just so much going on when we talk about scares on tariffs, when we talk about US credit being downgraded. I mean, so many different things for us to really take a look at. Now we're obviously going to really do a deep dive into what happened the prior week, like we usually do, and then really kind of take advantage of getting a firm understanding as to what is the expectation now when it comes to how the U.S. debt is being perceived, and really how we could truly take that into a additional step further. One, to educate our clients, but two, to truly just kind of find out exactly what are the necessary resources that we should be taking on as industry professionals, to truly educate our clients, right? Because there's so much uncertainty right now. The market is on a huge roller coaster. Of course, I think we're going to see the ripple effect when it comes to the U.S. credit rating, obviously, like we're already seeing right now. But really important for us to understand that clients need us now more than ever, and I think it's just hypercritical for us to be able to take that additional step needed in order to truly educate what the necessary options are for them, right? Because I'll tell you guys, we're in the local market of New Jersey predominantly. We do lend in other areas, but really Jersey is our backyard. And a lot of people are out there buying, right? We tend to obviously get a little bit of nicer weather right now, but we'll dive right into it, right? So, what happened last week, right? So, inflation obviously came in surprisingly super low, right? CPI came in hitting a 4-year low. PPI, producer price index, once again also showed a slowdown with companies absorbing it. Now, if we do a deeper dive heavily even further, you'll kind of see that CPI came in at 2.3%. We were expecting a little bit higher. Core at 2.8, kind of showing if we take that 3-month average, we're at 2.1%, close to the Fed goal of 2%, right? Now, if we dive in even further, what we'll usually see on there, excluding food and energy, it only increased by 2.2%. Obviously, we're starting to see a little slowdown on gas, which doesn't really help me, right? Because obviously I just got an electric car, but it does help many consumers when it comes to that. Now, shelter costs accounts for 35% for CPI and 44% for core. Once again, showed a very heavy influence when it comes to the inflation reading. So again, bottom line, when we take a look at the consumer price index, inflation came in moving in the right direction. Headline and core lowest it's been since early 2021. Again, April tariff announcements is not fully reflected yet, so we'll kind of see how that impacts it. Used car prices did drop 0.5% in April. New car prices still remain flat. Now, wholesale, on the wholesale level, this was really surprising, right? It actually showed a huge cooling, dropping 0.5% for the month, as opposed to bringing that yearly increase to 2.4%, right? Slowly getting to that target of 2%. Home builder confidence, as expected, right, is obviously moving in the opposite direction, really mainly because of just this uncertainty of what we're expecting when it comes to the market, and really what obviously is going to be this transition. Remember, this can change very, very quickly. A lot of different factors. Again, we have elevated interest rates, tariff concerns, building materials, and just a general economic outlook that is unclear. 90% of survey responses collected before May obviously showed right after the tariff implementation with President Trump in China. Now, if we take a look at when it comes to new construction, one positive note: starts is up 1.6%. And then obviously everything else shows a little bit of a negative slowdown, as more or less expected, right? Um, when it comes to multifamily home and single family home, actually showed a reduction. We did see building permits also saw a little bit of a reduction. Once again, people essentially afraid to break ground when it comes to tariffs and things like that. Retail sales did pop up just a little bit of 0.1% in April versus March, slightly better than the expected performance. So let's kind of take a look at interest rates and how they're doing. Now, if we kind of take a look at where we've been really since last year, you can kind of see here. I mean, this is a little heartbeat monitor, But if we look at where the market was essentially around this time last year, let's say May of 24, we're kind of again right in line, actually a little bit less, right? Market, I think, is at 6.99 or ended at a 6.99 as of today. So you can kind of see here we've been battling pretty quickly. We were lucky enough to catch quite a few clients in these downward trends when it came to locking their interest rates and getting some refinances. We also were able to get a couple clients here also when we saw a little bit of a dip here fairly recently within the last month or so. So a lot of different factors for us to obviously take a look at, but main concern again is obviously seeing what is going to be as we reach the 7% mark. Is the Fed going to potentially step in due to all this uncertainty? Kind of take it from there. Now, that was last week, right? Now we take a look at now. We do know that over the weekend on Friday into the weekend, we know that there was obviously concerns that the U.S. credit rating was being downgraded. Right? What does this basically mean? I'm going to do a little bit of reading verbatim. Think it's just so critical for us to understand this stuff. The United States faced a credit rating downgrade, which is important for us to know because those downgrades really affect just the government balance sheet, and it also really affects just how the overall spending is going to be passed on to homeowners and prospective buyers. Okay, so if we take a look at understanding how this credit rating, three different factors for us to look at. One is risk signal, right? This is going to alert investors that there's going to be an increased higher lending risk. I think we're now rated at an AA1. The agencies Moody, S&P, and Fitch were all in agreement to lower our rating. This is the third time. I believe it was 2011, 2023, and then now we're seeing this reduction on our credit rating. Bond market reaction, obviously, investors demand higher yields, which is why we're seeing interest rates start to tick up. And then housing market, right? Usually, higher interest rates creates a little bit of reduced affordability. Again, like I shared earlier, people are still actively searching and actively still buying, right? Now, of course, just like I said, this does potentially, react and kind of cause a little bit of an increase when we talk about the interest rate market rate increase of 0.5% to potentially 1%. I don't think it'll jump up that high, but let's say for an analogy, if it is half a percent, be a $300 a month higher payment if you're at a $400,000 price range of a home, potentially 10% approval impact. Remember, any drop in interest rates of 1% potentially opens about 5 million buyers to enter the market. Cooling home buyer demand, what does this do? A little bit of reduced buying power, extended market time. This conversation I was having with a colleague earlier is if the house is priced correctly, the house is flying off the market, if not seeing multiple offer situations. If a house is listed too high, which some clients may be in a position thinking that they're able to get that much, the house is going to sit, and when the house sits, obviously, you start seeing price reductions, or you start seeing really just buyers tend to flock away from the home, assuming that there's issues with it, which goes to my third point: price adjustments, right? Sellers reducing the asking price, then obviously market cooling, less competitive offers being done. Impact on home prices. So in some areas, when it comes to high demand markets, areas with strong job growth could experience a little bit of a slower appreciation. We are seeing that in some areas like Texas, Florida, some areas in the Carolinas, right? A little bit of a slower demand. Mid-tier markets, again, moderate price homes. Once again, you'll see price stagnation. And then cooling markets, again, you'll start seeing a little bit of price reduction. I'll tell you guys though, in Jersey specifically, it is still super hot. We're starting to see such a massive more inventory start to come, which is very typical around the spring and summer, especially in our area. But inventory is still tight, right? We do see a little bit of reduced mobility, right? Some owners may be a little bit more holding back potentially on placing their home on the market to kind of see how this market pans out. Industry contraction, which is kind of what we're seeing, a little bit of reduction on staffing, and then rate lock in, homeowners retaining that lower interest rate, right? Tighter lending standards, right? So higher credit score requirements, lenders usually raise about 20 to 40 points when it comes to this. We're blessed, with my institution with PRMG, right? Very, if any, uh, lender overlays when it comes to stuff. We are usually straight Fannie Mae, Freddie Mac. If there's a set guideline that is in place, that is what we are using and adopting. Nothing higher, nothing lower, right? Some institutions may necessarily have higher requirements. We saw this during COVID, right? Some local institutions were actually putting some of these requirements on having a 700 plus credit score, not going 3.5% or 5%, in some instances 10% and stuff like that. And then, like I said, stricter DTIs, right? They won't go as high as 45 to 50. They'll drop it to potentially, right, 36% to 43%. And then really the last strategic responses, right, that we could do for homeowners. Best opportunity if you're on the fence or you're really just trying to pan out to prep yourself. Protecting your credit score is super important, right? Remember, your utilization is about 30 to 35% of your credit score. Between that and your payment history, it's almost about 60 to 65% of your score. So critical for you to stay on top of those two things. Other factors like new accounts, balances, and things like that make a factor, but so important to stay on your utilization, your payment history, increase savings. Right? Remember, you could purchase a home putting as low as 3.5% down or 5%. Yes, you're going to have this scary thing of private mortgage insurance, as many people, right, usually tend to flock away from. It is not necessarily the absolute worst thing. Both of my homes that we bought, first was 3.5, then 5%, and it was not something that we were looking to do. Different from our alternative, right, properties that we own from investments. Obviously, we knew from that standpoint we were going 20-25% down. Exploring alternative financing, right? Some instances you have seller financing and stuff, which again is not going to be as prevalent in this market. And then negotiating aggressively. Some instances we are seeing a little bit more opportunities for clients to ask for sellers concessions or seller credit. So that is something for us to potentially take into consideration, right? So again, so many different options for us to take a look at. It is just so critical that if you're somebody out there, whether you're a professional or you're a client who's searching for a home, you're finding that right lending professional who is going to guide your clients, educate them, most importantly, kind of put the best options in front of them in an effort to truly make the home buying process as simple, as seamless as it gets. Appreciate you guys jumping on. As always, if you guys have any questions, feel free to DM me or visit our website, gotmortgages.com. Thanks, guys. I'll talk to you guys soon.